Good evening. While you were sleeping, JPMorgan quietly launched a live blockchain token. Citi followed. The DTCC, the clearinghouse that processes 10 trillion in trades, just went on chain. And no one's talking about the $46 billion venture capital firm orchestrating this entire revolution. So a16z operates across 7 specialized funds: AI, American Dynamism, Defense Tech, Bio, Health, Consumer, Crypto, Enterprise, and Infrastructure. The crypto arm alone, 7.6 billion across 4 dedicated funds, and it's run by Chris Dixon, who's been there since 2012, before most people even knew what Ethereum was. But here's what nobody's connecting. In April of 2024, they raised 7.2 billion in new capital. Forbes confirmed that Ben Horowitz now has 45 billion as of May 2025, and they're not slowing down. They are accelerating. And according to leaked reports in late 2024, they're planning a 20 billion megafund that's targeting AI and defense tech. If that closes, they'll control more capital than most sovereign wealth funds. According to 16z's official TradFi playbook, which was published in 2024, JPMorgan's JPMD coin already went live. This isn't a stable coin like a USDC or a Tether. It's a one-to-one tokenized representation of JP Morgan's commercial bank deposits. Think of it as a digital receipt that lives on the blockchain. It moves in seconds instead of days and settles 24/7 instead of waiting for ACH batch processing. Why this matters is because traditional cross-border payments take 3 to 5 business days and can cost anywhere between 25 to 50 cents per transaction. The JPM token only takes minutes and only a few cents. They are interoperable with public blockchains like Ethereum, which means corporate treasurers can now move capital between JP Morgan accounts, DeFi protocols, without ever leaving the banking system. And this is a breakthrough. a16z's research confirms JPMD is being used in trade finance, treasury management, and cross-border payments. Imagine you're a multinational corporation with suppliers in 12 countries. Instead of maintaining correspondent banking relationships, wiring funds through SWIFT, and waiting for days for settlement, you just mint a JPM token, you transfer it instantly, and your supplier redeems them for local currency through their own bank. Wall Street efficiency just got crypto level fast. The JPMD runs on Quorum, JP Morgan's permissioned Ethereum fork, but it's designed to be interoperable with public blockchains through bridge protocols. That means that the corporate treasury can hold JPMD, swap it for USDC on Uniswap. They can stake it in a yield generating protocol like Aave and then redeem it back into dollars, all without touching a traditional exchange. The Citi token services launched in 2023 and is now handling deposit tokenization across multiple blockchain networks. According to 16z's analysis, Citi isn't building on just one chain. They're building and deploying on multiple permission ledgers and designing for eventual public permission hybrid models. Translation: they're hedging their bets on which blockchain standard wins institutional adoption. Here's where things get fascinating. Citi isn't just tokenizing deposits, they're offering programmable cash. Corporate treasurers can set rules, release 5 million to supplier X only if conditions Y and Z are met. That's escrow logic built into the token itself. No lawyers, no intermediaries, just code executing pre agreed terms. And Citi charges a premium for that automation. What sets Citi from JPMorgan is global reach. Citi operates in 160 countries. Their tokenized cash can clear through local regulatory frameworks, but it's still a bank deposit, just with blockchain settlement rails underneath. For multinational corporations, that means that they can manage global liquidity in real time without maintaining accounts in every jurisdiction. That's 200 billion cost savings opportunity according to McKinsey's estimates. So, let's talk about the Depository Trust and Clearing Corporation. Here's the problem that the DTC is solving. When banks need post collateral for different trades, they have to lock up capital in separate accounts, wait for batch processing to confirm it's available, and deal with multi day settlement cycles. That ties up billions of dollars in unproductive capital, just sitting in escrow. The financial industry calls this collateral fragmentation, and it's been a thorn in Wall Street's side for decades. The DTCC's Smart NAV pilot tokenizes net asset value data on a blockchain. Think of it as turning your collateral into programmable Lego blocks. Instead of physically moving assets between accounts, you just update the blockchain ledger. Settlement that used to take T plus 2, that's a trade date plus 2 days, now it's near instant. Capital that was locked up now is fluid and reusable across multiple transactions in the same day. According to a16z's analysis, the Smart NAV lets collateral behave like programmable liquid money. That means a hedge fund can post the same collateral for a repo transaction in the morning, reuse it for a derivative margin call in the afternoon, and still have it available for overnight funding, all without moving a single dollar. Industry estimates suggest that this could free up 50 to 100 billion in trapped capital across the financial system. Okay, let's talk a little bit about zero knowledge sync. Zero knowledge sync uses zero knowledge rollups, a cryptographic technique that allows you to bundle thousands of transactions into a single proof. You settle them on Ethereum's main chain and maintain full security guarantees. The translation of that for non-techies, you get Ethereum security, Bitcoin's finality, and Visa's speed all in one package. That's the holy grail for institutional adoption. According to a16z's playbook, it reveals that the zero knowledge sync is being tested for two specific applications: near real time cross border payment settlement and intraday repo markets. Let me break it down. Cross border payments today can take 3 to 5 days and cost $30 to $50 per transaction. Zero knowledge sync brings that down to under 10 seconds and less than $1. Intraday repos, short term loans where banks lend each other cash against treasury bonds as collateral, currently settles in once per day. But with zero knowledge sync, they can settle continuously through the trading day, massively increasing their capital efficiency. Now, according to the Zero Knowledge Sync's public roadmap, they're targeting 10,000 transactions per second by Q2 of 2026 with sub-second finality. If they hit those benchmarks and the pilot results validate the business case, you can expect a flood of institutional adoption announcements in late 2026. This is the inflection point where blockchain stops being a buzzword and starts being boring infrastructure. Let me talk a little bit about R3 Quarter. In 2024, R3 announced the integration with Solana, allowing permission quarter networks to settle assets directly onto the Solana public blockchain. According to a16z's analysis, this is the first major instance of bank-grade permission system connecting to truly decentralized public chain. Now, why does this even matter? Banks love permission blockchains because they control who participates and can comply with Know Your Customer, anti-money laundering regulations. But the downside is that every bank's blockchain is an isolated island. If JPMorgan tokenizes an asset on Quarter, Citi can't automatically access it unless they're on the same network. But when you enter Solana as a neutral settlement layer, banks can keep their private networks but use Solana for the final clearing venue. It's kind of like how individual banks settle with each other through the Federal Reserve. Now, R3 has over 300 institutional members. Even if 10% start using Solana as a settlement layer, that's 50 plus billion in institutional capital flowing onto a public blockchain. Here's the kicker. Those institutions won't be buying SOL tokens, they'll be burning SOL for transaction fees without even realizing it. It's quite a supply sink that could drive Solana's next bull run. And lastly, a16z's 23 million political bet. As we review their regulatory playbook for 2026, while most VCs lobby quietly behind closed doors, a16z has gone on the full offensive. In 2024, they announced a 23 million contribution to Fairshake, a bipartisan crypto super PAC funding pro-blockchain congressional candidates. And this is where it might just terrify traditional finance. They're not asking for regulation to be rolled back. They're writing regulation themselves. a16z's policy chief, Brian Quintes, who was formerly a CFTC's commissioner, spent thousands of hours meeting with lawmakers, drafting legislation language, publishing over 100 policy papers. This message is very simple. We're not asking you to remove the rules. We're asking you to create the right rules so that we can comply. That's genius positioning. Every industry comes to DC asking for deregulation. Crypto's asking for clearer regulation and offering to help write them. And lastly, these are not theoretical proposals. They are running live pilot to digitize over 42 million vehicle titles on the blockchain. Utah's doing the same thing, so is Wyoming. On the federal front, a16z is backing the Genius Act, that's the stablecoin framework, and the Clarity Act, that's the digital asset market structure. Both bills have bipartisan support. If passed in 2026, they would be creating licensing pathways for stablecoin issuers under 10 billion, exempt non-financial tokens from securities laws, and establish a federal framework that preempts state-level patchwork. That's the end game. A unified rule book that lets institutional capital flow freely. I hope that you enjoyed this session and have a good evening.